Bernstein's Toni Sacconaghi saying he expects iPhone revenues to disappoint in 2023 and sees potential downward revisions as the year goes on. Given that, he also says Apple is too pricey here. He just cut his target by $45 to $125 a share. Toni Sacconaghi joins us now. He's senior research analyst at Bernstein. It's great to see you, Toni. And a lot of people have Nancy Tangler just said she's buying it. This is a good entry point for the long run. Why are you bearish, not just for the near term, but potentially for the year?
Sure. Well, thanks for having me on, Kelly. Look, I think there's important context here. The tech sector overall was down 34% last year. Apple was down 29%. So it fared a little bit better. So on a relative basis, Apple isn't any cheaper than it was 1 year ago. I think more importantly, when we look to fundamentals, Apple has had a great 2 years. Operating profit on average in the 5 years going into the pandemic was about $66 billion. Last year was almost $118 billion. So we had this huge surge in profitability over the last 2 years, I think in part because Apple was a COVID beneficiary. And we think we may see some give back this year for sure. So we're below consensus estimates. We're at about $5.80 a share. The street's at about $6.20 a share. And we think as numbers come down, it's tough for stocks to work, particularly since Apple is not inexpensive at current levels.
I think it's a great point. We talk about the pandemic reset in chips and even in cars, and most people thought Apple might be a little different story, in part because of the services and the subscriptions as a service. For those new handsets that were sold, why won't the reliability of service revenue help them get through a time in which hardware sales might be slower?
Well, it will help, but it's simply not big enough, Kelly.
Yeah.
So services revenue in total is about 20% of Apple's revenue, about a third of its profit. But more importantly, most of that services revenue is not recurring. Most of it is App Store and advertising. And both of those are subject to the overall health of the economy and consumer spending. So we estimate that only about 6 or 7% of Apple's total revenues are recurring in nature. And so it is a transactional business model. Apple needs to sell iPhones, iPads, Macs, and benefit from advertising and App Store for the business to work. And there really is very limited recurring or subscription revenue at Apple.
What do you think a justified multiple is here? So it's a 21 times. Are you questioning kind of the consensus earnings trajectory? Do you think the multiple just needs to come down to something maybe in the low teens like we've seen in the past?
I think that's the big debate on Apple, Kelly. Apple used to trade at a discount to the market. Right now, it trades at about a 30% premium to the market. The market's at about 16 times. Apple's at 21, 22 times. And I think that's a big debate with investors. My concern is that if numbers come down and iPhone disappoints, then investors may say, look, the story of Apple being this, impervious consumer franchise, not cyclical, there may be some doubt cast on that. So yes, maybe numbers come down 4, 5, 6%. That's not that big a deal. But if the multiple comes down because people start questioning the thesis that Apple is this durable, impervious consumer franchise, we could have some multiple compression. Now, I still think Apple deserves to trade to a premium to the market, but whether that's 10% or 20% is hard to say. The final point I'd make on valuation is every large technology portfolio manager is trying to make a decision on 5 big tech stocks, the FANG stocks, Microsoft, Apple, Amazon, Google, and Facebook. They comprise more than 50% of the technology index. Apple is much more expensive than Google, much more expensive than Facebook, in line with Microsoft. And all of those companies have better growth. And so the valuation is not only absolute, it's relative to the largest choices that large technology portfolio managers need to make.